Hey everyone, welcome to the final installment of The Truth About Permanent Life Insurance with Jeff Bernstein. This is the episode where we will finally answer the question on who is the ideal candidate for a permanent life insurance policy. I want to take a moment right now to thank Jeff Bernstein for educating us on this complicated subject. He's been really patient, really thorough. I sent him like 6 pages of questions, and he has been very transparent. And as you'll see in this episode, he answers some really tough questions, including the question about how much commission can be generated when one sells this policy. And I have to tip my hat off to Jeff. He's answered questions that not everybody in this space would necessarily be able to. And along the way, as these episodes have been released, I have had people in the industry reaching out to me, telling me that they respect what Jeff Bernstein has to say. So I'm grateful to have him on the podcast. I know that many listeners are as well. Now, one important point I do want to communicate is that I think when we're learning about a complicated subject like permanent life insurance, it's important to be learning through the right resources. Jeff mentioned in the last episode that people had been learning about certain concepts on TikTok. And this is not to knock TikTok, but I don't necessarily think that TikTok, like a 10-second snippet, is the right place to be learning about something like permanent life insurance, because sometimes you only scratch the surface, but then important details can be left behind, something to keep in mind. The last thing I want to bring up is that many of us are aware of the white coat investor, and I myself benefited from his first book, The White Coat Investor, which honestly was one of the resources that first got me started on my personal finance journey. It taught me that there's a lot to learn about in the real world beyond medicine if I am to succeed. And for many of us who have followed him, you will quickly see that he is very critical about permanent life insurance. And I do think there are pieces in his message that are relevant to Canadian doctors when it comes to permanent life insurance. However, I do not believe that his entire message is completely relevant to Canadian physicians. Let me try and explain this. So many Canadian physicians will incorporate their medical practice, and we are in a fortunate position to be able to do so. In the United States, that's not the case. Generally speaking, physicians do not incorporate their medical practice. They may go on to incorporate for other reasons, but it's not typically related to the practice of medicine. So why is this piece of information so important? Well, it's relevant to a lot of what we learn on this podcast, including permanent life insurance. So some of the important concepts that we have learned on this podcast is that incorporating gives us the benefit of tax deferral. You leave more money behind the corporation that you can grow over time, and you can do different things with this money. So for people who have done all the right things, like maximize their registered accounts, diversified in a common sense, evidence-based way through a diversified portfolio, and who have built a nest egg, and for people after doing all these things, if they have money left behind that they need to get to the next generation in a tax-efficient way, well then permanent life insurance that is held through a corporation utilizing the benefits of corporate tax deferral to get money tax efficiently to the next generation can become a very worthwhile and interesting strategy. And that's why I believe that the white coat investor's message on permanent life insurance is partially relevant, but not completely relevant to incorporated Canadian physicians. Now, I'm not at all trying to knock the white coat investor. He's done so much for financial literacy in our profession, but I do think that this is one distinction and one message that is still important to get across. And without further delay, here's the final installment of my interview with Jeff Bernstein on permanent life insurance. Okay, Jeff, let's maybe wrap it up with the very final segment, which is the shortest segment. We've talked about permanent life in a lot of detail today. And I encourage everybody to go back and listen to the previous segments, but we talked about why you do it. And I think you've mentioned that it's a lot of people who are well off in life, fairly affluent, may benefit. But I really want to nail down the who and when. And I don't want to put words in your mouth, but to me, when I think about it logically, to me, it'd probably make more sense if some of my registered accounts have been taken care of, have been maxed out. It would probably make sense to me if I have a sizable chunk of my mortgage paid off, just so that these premiums can go into the policy without any concern of other outstanding commitments. Who and when?
Yeah,
would that's what I want to answer here.
Yeah. So, and of course, like none of my comments are brief, right? But at the simplest level, it's someone with commitment to stay the course, surplus cash, so all those things you said, and their good health to qualify. We rarely talk about this point. Like, this is so overlooked, but good advisors remind their clients that although their money may pay for premiums, it's their health that actually buys the insurance. This is a weird way of looking at it from for you probably, but permanent insurance can create big winners, but equally big losers. And I don't mean like, the advisors are the big winners, right? But losers are the ones who lapse their policies. Those are the ones who, they bought too much, they couldn't stay the course, whatever it was, they gave it up. We're going to talk about the exit options. But winners are those that benefit by staying in the pool. They stay invested and they benefit from those lapsed policies. We talked, I think we were exchanging notes on the Rational Reminder podcast. There was like a whole interesting attribute that they could have talked about, I think, around this as like lapses as an alternative asset. It's way too complicated for this place here. But, to pay the most expensive premiums for any product available, which generally, like, these are the types of products that are, you can have less costly permanent insurance, but that's not who is considering this. To walk away from that after a few years, that sucks. Like, that's a bad deal, right? I think specifically, once you add corporate ownership to the mix as well, so this offers the ability to use, cheaper dollars in Ontario, right? We're talking about 12% as opposed to, 53-54%, and maybe increasing, right? Like, I'm not a fear monger. I'm not going to talk about capital gains and income tax, but there was a time in our country where income tax rates at the top level were like 90%. So using those cheaper dollars, providing the family with tax-free proceeds via the capital dividend account, and also, as we talked about, offering access to those living values as a potential retirement supplement. These are just sweeteners. It just makes permanent life insurance an important consideration. Doesn't mean that you have to do it. So to generalize for your listeners, if you're younger, if you're graduating with debt, if you're in a period of flux, if you're locuming or you're thinking, and like, I loved your episodes on, your mistakes, not because I was like, schadenfreude celebrating your mistakes, but like, you're right. Like, you're in a place that might not be your forever place. Like, I don't know what I'm doing with my, I'm 38. Like, what am I going to do for the next, 30 years? I think I'm doing this. If you're thinking about where to put down roots, you don't already have the most robust disability insurance policy that makes sense for your risk profile, and go back and listen to your other episode because it was great. Plus plenty of income replacement protection from term insurance. You are likely a poor candidate for permanent life insurance. There's, again, you can cut this, but I think incorporated professional, business owner, real estate investor, otherwise high net worth individual who has accumulated or expects to accumulate significant assets beyond those needed for your own lifestyle consumption, importantly, is stewardship minded and wants their loved ones or their loved causes to benefit from a larger estate. It almost always makes sense to consider permanent life insurance for some of one's long-term portfolio of wealth.
That's beautiful. That resonates with me. That makes a lot of sense. Now, I find of the policies that are pitched, I find par policies to be the most frequently pitched. And then this whole concept of commissions comes up. And Jeff, like, I want to be totally reasonable here, and perhaps it's not fair for me to ask, like, what kind of commissions do people generate when they sell these policies? Because I think there are physicians out there who may not want people asking, well, how much did you bill last year, right? Like, that's sometimes an unreasonable question, but then the Toronto Star went ahead and basically published it all. And so, so I really need to know, because I think it's a point of contention for people. People will often brush aside permanent life insurance and say, hey, you know what? The advisor who's going to sell this is making a crazy, crazy commission on this. Therefore, it's automatically a conflict of interest. My approach is, if this information is better understood up front and more transparent, I think that's then put aside and we can actually focus on why you would pursue something like this. That's why I want to ask, like, what are the commissions, ballpark, whatever you can offer here. I'm just curious.
So I'm going to give you like real specifics here, but as I've done during this episode, I'm going to go off on a soapbox, and I think these are important comments, and divide them up as however you need to. But it's important to share some thoughts on this, because I think it's really important from a trust standpoint for consumers of financial products to gain access to more transparency, and for us to defend certain realities and also to call out practices that don't belong in our industry and things that we don't control, right? I would actually say to you that the way that most par policies being designed and sold today, so we talked a lot about estate versus cash accumulation or investment growth. I think the accumulation part is at least a significant factor in design. I would actually argue that commission structures are not incentivizing more sales of these products, but that consumers in this iteration of the marketplace have become more comfortable with accepting some of the risk in exchange for reward that these policies offer. So, notwithstanding, like there's always, as you said, like strong and very tempting potential for bad actors to manipulate outcomes that exist when commissions and sales-based incentives are involved. Insurance products are sold in generally efficient market cycles. The tailwinds of chasing yield and PARs, like the smoothing effects that we discussed previously, during the last many years of ultra low interest rates, these propped up many sales of PAR. But so did the actuarial and product innovations of insurers actually designing structures to benefit consumers, like to match and exceed the flexibility of universal life, or when they reprice term to 100 because they bear the entire risk, insurance companies, and they absorb huge losses on their actuarial assumptions during the last many years of mortality improvement. So they've done things that have been good for consumers. They haven't necessarily been great for advisors. And if you want to like dig deep into LinkedIn comment threads, like you'll find stuff. But most of the time when products specifically like PAR are designed appropriately with lower minimum commitments and higher voluntary contributions, these are far better consumer-focused outcomes than the alternatives. So long as insurance companies can actually achieve distribution of these solutions, which is not something that has been effectively solved without, advisor broker intermediaries like me in the higher net worth and business market spaces, they're going to continue to follow the money. So from a sales perspective only, and I'm not speaking about all the other things, but product design goes where premium dollars are. And most advisors, I think, have become savvier at steering clients away from, more blindly accepting what have become poorly priced guaranteed products or locking in their pricing on dated assumptions of mortality. But this has actually come at an eroding cost to advisors. So this is where I'll go about commissions. So as a rule of thumb, one can think of commissions equaling roughly double the minimum first-year premium one makes into a policy. Exact dollar amounts will depend very heavily on an advisor's overall production levels at both an industry and company-specific level. But the minimum premium point is really important to emphasize. I'll give you an example, but if we look at the industry average payment duration, you buy an insurance policy, most people are depositing money for 10 years. Using that metric, advisor commissions are going to average about 5% over that period of time. The problem is that 95% of it is earned at the point of sale, essentially. So this is a discussion for another day about aligning client incentives, advisor behavior, insurance companies, things like that. But to give you a numerical example, it is not uncommon for owners to deposit six-figure sums into an insurance policy. They could do five figures, they could do 4. It doesn't matter. It's not it's a scale thing. But we're not thinking about this from the standpoint of solving for an insurance death benefit. I'm not saying like my family needs $5 million of life insurance if I died yesterday, so therefore I'm going to buy $5 million of permanent insurance. But you're looking at your tax shelter deposits. So using $100,000 as an example, if I were to put $100,000 into a policy, an advisor, depending on how the policy is structured, could net anywhere from $20,000 to $150,000. There are always very case-specific nuances that call for how that solution was structured. So it's not just how much did this person make on the other side. The challenge that you will rarely know, right? And there may be a very good reason for the advisor earning a number that's closer to the top tier of that, the 100,000 or 150,000 range. But there are also just as many good client-centric reasons for designing a solution that requires far less minimum premium and therefore skews our compensation way closer to the bottom range of that example. More comments, but I think the biggest issue behind optimal product recommendations, apart from the actual lack of knowledge, like an advisor not knowing or having, standards of excellence, is the fact that your same dollars in that $100,000 leads to two such wildly divergent outcomes. And, which do you think influences advisor behavior most, right? If I'm having a bad year and, there's an opportunity that comes across, it takes a lot to say, I'm going to put the client outcome first, when they won't really know. They won't necessarily know that, the alternative wasn't done. And if they do, it's going to be years before they really figure that out, unless they happen to take it for a second opinion. So, everything I say here, these are obviously my personal views, and I'm not expecting any sympathy from listeners on this point. But, I do want to defend and say that elite advisors, while sometimes compensated outrageously for seemingly little effort, they are most often than not worth their dollar value. And, there is a lot that goes into this level of advice. You're coordinating with and sometimes even paying for the client's tax and legal advice. You're investing in office administration and client service, no different than a physician, who runs a practice would, right? You're collecting and chasing down a patchwork of medical information and evidence. Clients rarely, if ever, see all that work or appreciate it. And, we also do the work on spec, as you know, right? Like, there is zero promise that we will ever recoup our investment. Many times a case will fall apart, whether that's because of underwriting results, the business realities of that individual's, circumstances, or maybe even personal dynamics between, families, partners, or other advisors. I didn't tell you that my brother-in-law is an advisor, and, I had you do all the work, but I'm giving them the business, whatever, it doesn't matter. But after the work is completed and all that opportunity cost of our time is invested. And, I will say that good advisors, those of us that hold ourselves to fiduciary standards when, this is strong, but our feckless regulators don't require it, or who continually invest in our own knowledge and growth at cost through, designations and education that's designed to improve collaboration between professional advisors for client benefits. Like, we make recommendations that are first and foremost good for their clients and not for our wallet share.
I'd like to take a minute to talk about a company that I've been following for a few years now. I initially met them on this very podcast and was taken by their story and passion to make life better for doctors. Introducing Aria Health, the groundbreaking electronic health records company that's redefining the way doctors practice medicine. Aria Health is all about putting doctors back in the driver's seat, in control of your destiny to become the doctor you've always aspired to be. Aria Health is not your typical EHR company. They're all about keeping the focus where it belongs, on you and your patients. They want to empower you to be caring, present, efficient, and powerful in your medical practice, without the burden of endless note-taking and paperwork. Join the Aria Health community of doctors who are already taking back their lives and practicing medicine the way they were meant to, free of corporate shackles, one patient at a time. But that's not all. Your time is precious, and you want to get back to what truly matters. Aria's unique promise is to get you up and running as a new clinic in less than 30 days. And if you're thinking about integrations or migrations, don't worry. Aria can get you set up in less than 2 months so you can seamlessly transition without missing a beat. What sets Aria Health apart is their unwavering commitment to helping doctors thrive and making doctors the heroes of the healthcare story. They leverage the power of artificial intelligence, handling complex data ingestion and automating workflows so you can focus on patient care, not paperwork. And I've seen this in action myself. Visit ariaehr.com. That's ARYAEHR.com and discover how Aria can empower you to take charge of your medical practice. You can use a special code beyondmd to get your first month for free. Jeff, that's really well said. I have to really acknowledge you for being just so candid and how you approach that topic, tackling a topic that I think wouldn't be so easy to do for some other people. So thank you for that. Let's say there's a commission of let's say $25,000. I mean, I guess the next question somebody has is that coming out of the money that I put into the policy, or is that coming from the insurance company, or a bit of both? Is there a way to answer that or to know?
I mean, the sales way of saying it is like, oh yeah, and like you're not paying me, the insurance company's paying me, right? But where are they getting the dollars from? Like the dollars are coming from premiums, and they're not all coming from your dollars. Like some of that is going to come from the pool. That's the expense, portion of of the metric that's not disclosed. So all of these things contribute towards it, and that's why like when you're an investor in this, or you're an owner, or you're a potential purchaser of this, you want to make sure that your objectives are well aligned with with the advisors, but like with good outcomes, and that's why it's hard. It's sometimes hard to know what the best thing is, and I do think that having open and fair discussions, not, as you said, like the way that you positioned it was the exact right way, not to say and dismiss that like this is crap, but the reality is that this is not an open marketplace. Like you can't go to Sun Life or Equitable Life or Manulife and say, I understand and I will take on the cost and the burden of acquiring this. Give me, $10,000 off my premium and give me the insurance. And I don't need to work with a Jeff, right? Mm-hmm. The option isn't there. Maybe one day the option will be there. The common mantra in our industry is that insurance is sold, not bought. There is like often a lot of truth to that. Many people just don't know about this. They're not educated accountants. They hear it all the time. Like they get the sales pitches, but they don't necessarily understand what insurance can do. So these are really hard issues to disentangle. And, the reality is like, we don't have a fee-based option, right? We could say, and like, I would gladly say this to a client who asks. I'll say we've done this in our firm before with big contributions. Hey, we're going to make a charitable donation with some of our dollars, right? Like we're going to tithe ourselves 10%, 20%, whatever it is. Like we will do things that we feel are good for us and the world, but we can't control how much money we make, other than the fact that we can make certain design recommendations. Or depending on the client's circumstances, there are certain factors that are going to lead to, one or another path.
And Jeff, this is the very last question before any closing thoughts, which I really want to give you a chance. You mentioned if a policy is unexpectedly canceled, you will get the cash surrender value back, right? But then the rest of it, you don't get back. That's correct?
Okay. So
I honestly, I don't want to open up a can of worms. No. I don't want to.
It's a good can of worms, right? Like, it's not, but it is. It's just the reality. So, exiting, canceling, like this is the doomsday scenario for me, in my opinion. But I think any responsible person has to ensure that there's at least like some understanding and knowledge level of what the exit plan or contingencies are going to be when investing in this kind of policy. So, those are going to include, and I'm going to talk about cancellation in a minute, but you could cancel the policy. You could reduce the amount of insurance that you've purchased, either the voluntary, like flexible discretionary amounts, or, the base insurance plan. Or you could donate the policy to a charity for, fair market value of that policy. Cancellation is the worst option. Like this is the costliest option. This is the thing that, blows up the plan, because like, depending on when you did this, much, if not all of the cash surrender value of a policy will become taxable, and not taxable as a capital gain, which is what a lot of accountants think, but taxable as income. And, this is the stuff that not that we're hesitant to tell people, but, we don't want to put stumbling blocks, but, the more generous reading of this scenario is that the primary benefits to permanent life insurance, other than like the function that it delivers for families, whatever, but, the primary benefit are its tax treatment. So, I think it's reasonable then to say that the cost to walking away will be equally punitive because of its tax treatment. Mm-hmm. You can't have it both ways, right? You can't shelter for a few years and not pay the piper. You gotta, if you keep it in there, you exit when you're dead. Like that's a great outcome for your family on in terms of financially, but not walking away. The best advice, and like maybe this is, particularly, salient for closing remarks. But, weird thing to say as an insurance advisor, but don't overbuy, and make sure that whatever you do with those dollars that you have designated for this investment, you are comfortable staying the course with. So this is also why I, even though it doesn't pay me a lot, like I'm super passionate about telling people to buy lots of term insurance now. Buy it now. It's cheap, and your family will probably need it and want it more now. And convert it later. That is a form of permanent insurance. Like I absolutely think you can view it that way. And it's also a hedge against short-term decisions based on a lack of information about your future state, your future wants, what you're going to be capable of. Do I like my kids? Like what does the tax environment look like in 20 years? There are pros and cons, but I think having as much of your powder dry as possible is a great thing to do. That's what I would say.
Jeff, you've spent literally 2.5 hours with me today on producing, honestly, what is like a landmark episode for my podcast. Like I said, it's just taken me so long to get to this point to tackle it. So a deep, just genuine, sincere thank you from me. But I also want to give you a chance. Like if you have any closing remarks that you want to share with listeners, anything you want to mention, I'd really love to give you that chance.
Thanks. Yeah. I mean, first of all, I think just as a general comment, I've told you this many times, whether on LinkedIn or by email, what you're doing for your audience is super. We know this isn't a moneymaker for you, right? But this is just, it's a really good way of breaking down some concepts. And yes, this is like a more loaded topic. We know that. I know that it's why you took so long to kind of come to it. But, I've tried to be candid and, really open and truthful with a lot of my remarks. This is more than any client will ever engage in like, I'm not even talking, like we haven't even shown an example, right? Like I haven't even said to you yet, and like, hey, you need permanent life insurance. Like we're going to buy this now or something, like we're not talking about that. We're just talking about the architecture of thinking through the decision and what's involved. I would really tell people, like, don't be scared to engage the topic, but, be invested in the outcome. You don't have to walk away from whatever exercise you're doing, whether it's insurance buying or investment buying or, real estate, whatever it is. Like, you don't have to be the expert, but you need to know enough to ask questions that are going to involve you and, your future self. So, take some responsibility in that way. Hold your advisors, your mentors to a high level of excellence. Like ask them about their designations, ask them for, client testimonials, ask them, who they serve, right? And observe how they put themselves out in the market. And these are things that, these are good for families to do. It's not evil, right? Like these are good outcomes that can lead, from these decisions, but be informed about it. Take the time and, don't put it off until you're too old for it to matter. And that's really it, live your life.
Really well said, Jeff. And, I just want to wish you continued success, all the best to your family as well. I hope one day our families can connect.
I'd love that.
I just love connecting with people on this journey, and I'm really happy to have connected with you. So, Jeff, thank you so much for your time. Hey,
thank you. I appreciate the opportunity, and take care of yourself. Enjoy the trip to Italy, and we'll catch up.
I will. Take care, man. All right, there you have it. A to Z on permanent life insurance. I really hope that was useful, and I really hope that this combination of episodes will give people a bit of a roadmap, maybe a little bit of a guidebook to navigate this topic with a little bit more conviction if you do decide to consider it. And remember, whenever you consider a product, consider signing up for something new, just ask yourself why you're doing it. Do you understand it? And you can ask the right questions going forward and connect with the right people and learn through the right resources. So guys, thank you again for supporting me on this series of episodes. I know it's quite the series, so please give me feedback. What do you think on a series of episodes like this on a complicated topic? Do you like it? Is it too much? I would love the feedback. Hit me up, beyondmdpodcast@gmail.com. And Jeff Bernstein's contact information is also in the show notes. So I'm going to take a break, a good 3 weeks. I need to rest. It's our 10-year anniversary coming up. My wife Seema and I will be traveling, and I'm looking forward to a bit of a break, but I will see you in December as the holidays approach. Stay well, stay savvy. Until next time.